what the financial system is. The financial system isn't one thing. It's a network of institutions, markets, and rules that move money from people who have it to people who need it. Sarah saves money. The bank takes Sarah's money and lends it to Mike, who wants to start a business. Mike uses that money to hire employees and buy equipment. Those employees spend their paychecks, which creates more business for other companies. Everyone wins? But in reality, that simple transaction involves dozens of institutions, thousands of regulations, and gets affected by everything from what the Federal Reserve decides in a meeting to whether there's a war happening on the other side of the planet. The financial system touches every single aspect of your life: your mortgage rate, your job security, your retirement savings, even the price of your morning coffee, determined by this invisible network of money flows that most people never think about. The role of money. Before money existed, if you wanted shoes, you had to find a shoemaker who wanted whatever you had to trade. Imagine trying to buy a car with chickens. You'd need about 2,000 chickens, and good luck finding a car dealer who wants to deal with that. Money has evolved from seashells to gold coins, to paper bills, to digital numbers on your phone. But the core function remains the same. It's a way to store and transfer value without having to carry around livestock. Money solves three massive problems. First, it's a medium of exchange. Everyone accepts it. Second, it stores value. Your dollar today should be worth roughly $1 tomorrow. Third, it's a unit of account. Everything gets priced in dollars, so you can compare the cost of a burger to the cost of a car. But here's what's wild. Most money isn't even physical anymore. When you check your bank balance, those numbers on your screen aren't backed by actual cash sitting in a vault. They're just digital entries in a computer system. About 90% of all money exists only as data. This creates entirely new risks. Instead of bank robbers with guns, we now worry about hackers with keyboards. Your money's security depends on computer servers and encryption algorithms instead of armed guards and steel vaults. How banks work. You think banks are like giant safes, storing your money until you need it. Wrong. The moment you deposit $1,000, the bank keeps maybe $100 and immediately lends out the other $900 to someone else. This is called fractional reserve banking, and it's completely legal. Banks make money on the spread. They pay you 1% interest on your savings, then lend that same money to someone else at 5% interest. They pocket the 4% difference. It's like being a middleman, except the middleman controls the entire economy. But that's not their only income source. Banks charge fees for everything: overdrafts, wire transfers, ATM usage, account maintenance. They make money on credit cards, investment services, and foreign exchange. Every financial transaction you make, they're taking a cut. This system works great until everyone wants their money back at the same time. That's called a bank run. And it's exactly what happened in 2008. Banks had lent out so much money to people who couldn't pay it back that they literally ran out of cash. That's why we have FDIC insurance. The government guarantees your deposits up to $250,000 per account. If your bank fails, you still get your money back. This prevents bank runs because people trust their money is safe even if the bank isn't. How money is created. Most people think money gets created when the government prints it, but physical cash is only about 10% of all money. The other 90% gets created by banks every time they make a loan. Here's how it actually works. You walk into a bank and ask for a $50,000 loan. If they approve you, they don't go to a vault and count out $50,000. They literally type $50,000 into their computer system. Boom! That money didn't exist 30 seconds ago. Now it does. This creates a multiplier effect. When banks lend out money, that money gets deposited in other banks, which then lend out most of that money, which gets deposited again. $1 of reserves can create up to $10 of loans throughout the system. But if banks create too much money too fast, you get inflation. If they create too little, the economy slows down. This is why we need someone to control the money supply. When money creation goes wrong, it goes really wrong. Zimbabwe printed so much money that a loaf of bread cost billions of dollars. Venezuela's currency became so worthless that people used it as toilet paper because it was cheaper than buying actual toilet paper. Central banks and monetary policy. Enter the Federal Reserve, the most powerful financial institution you've never really thought about. The Fed controls the money supply for the entire United States, and since the dollar is the world's reserve currency, they basically control money for the planet. The Fed has one main tool: interest rates. When they raise rates, borrowing becomes more expensive, people spend less, and the economy cools down. When they lower rates, borrowing becomes cheaper, people spend more, and the economy heats up. During the 2008 crisis, the Fed dropped interest rates to basically zero and started buying bonds to pump money into the system. During COVID, they printed more money in 2 years than they had in the previous 50 years combined. That's why everything got more expensive. 8 times a year, a small group of people meet in a room in Washington, D.C., and make decisions that affect the financial lives of billions of people worldwide. They decide whether your mortgage gets more expensive, whether your job is safe, whether your investments go up or down. Central banks face an impossible choice called the impossible trinity. They can't simultaneously maintain stable exchange rates, independent monetary policy, and free capital flows. They have to pick 2 out of 3, and that choice affects everyone. Financial markets. The stock market looks like gambling, but it's actually how companies raise money to grow. When you buy a stock, you're buying a tiny piece of a real company. When you buy a bond, you're lending money to a company or government. Here's why this matters. Companies need money to expand, hire people, and build new products. Instead of going to a bank, they can sell pieces of themselves to the public. This is how Apple raised money to build the iPhone, how Tesla funded electric car development. But markets aren't just about company values. They're driven by human emotions, fear and greed. When people get scared, they sell everything. When they get greedy, they buy everything. This creates bubbles and crashes that have nothing to do with actual company performance. Today's markets are dominated by computers making millions of trades per second. High-frequency trading algorithms can buy and sell stocks faster than you can blink. Regular investors are competing against machines with reaction times measured in microseconds. The financial markets aren't just stocks. There are bond markets, commodity markets, currency markets, and derivative markets. They're all connected. When oil prices spike, it affects transportation stocks. When the dollar strengthens, it hurts companies that export goods. The credit system. Your credit score is like a financial report card that follows you everywhere. It determines whether you can buy a house, get a car loan, sometimes even get a job. But most people don't understand how it actually works. Your credit score gets calculated based on 5 factors. Payment history, 35%. How much credit you're using, 30%. How long you've had credit, 15%. Types of credit, 10%. And new credit applications, 10%. Miss one payment and your score can drop 100 points. This creates a system where people with good credit get access to cheap money, while people with bad credit get trapped paying high interest rate. It's like a financial caste system that's incredibly hard to escape. 3 companies, Experian, Equifax, and TransUnion, know more about your financial life than you do. They track every payment, every loan application, every financial mistake you've ever made. And they sell this information to lenders who decide your financial future. The credit system is also incredibly vulnerable to fraud. Someone steals your social security number, opens accounts in your name, and suddenly your credit is destroyed. It can take years to fix damage that happened in minutes. Investment institutions and capital allocation. Most of the money in financial markets doesn't belong to individual investors. It belongs to massive institutions. Pension funds managing retirement money, mutual funds pooling small investors' money, and hedge funds playing with billionaires' cash. These institutions are supposed to allocate capital efficiently, moving money from dying industries to growing ones. When they work properly, they fund innovation and economic growth. When they don't, you get bubbles and crashes. A handful of investment firms, BlackRock, Vanguard, State Street, own significant stakes in almost every major company in America. They have more voting power in corporate decisions than most individual shareholders combined. Increasingly, investment decisions are made by algorithms, not humans. Passive index funds automatically buy stocks based on market capitalization, not company fundamentals. This changes how capital flows through the economy in ways we're still figuring out. The government's role in finance. The government plays a weird double role in finance. They're supposed to be the referee, making rules and enforcing them, but they're also the biggest player in the game, borrowing more money than anyone else. The US government owes $33 trillion. That's more than the entire economy produces in a year. They pay for this debt by selling bonds to investors, including foreign governments. China and Japan own about $2 trillion of US debt. When the financial system breaks down, guess who pays to fix it? Taxpayers. During 2008, the government bailed out banks that were too big to fail. During COVID, they sent checks to everyone and kept businesses alive with loans. The government regulates finance through dozens of agencies. The SEC watches stock markets. The FDIC insures deposits. The OCC supervises banks. Each agency has different rules, different priorities, and different enforcement powers. But there's a problem called regulatory capture. The same people who work at banks often end up regulating those banks, then go back to working at banks. This creates conflicts of interest and weak enforcement. Inflation and economic cycles. Inflation is like an invisible tax that steals your purchasing power. The dollar in your wallet today buys less than it did last year. Over 20 years, inflation can cut your money's value in half. There are different types of inflation. Demand pull inflation happens when too many people want the same things. Cost push inflation happens when production costs rise. Monetary inflation happens when there's too much money chasing too few goods. The economy moves in cycles: boom, peak, bust, recovery. These cycles happen roughly every 7 to 10 years. During booms, everyone feels rich and takes on debt. During busts, reality hits and people lose jobs, houses, and savings. Central banks try to smooth out these cycles by adjusting interest rates and money supply. But sometimes their interventions make the cycles more extreme. Easy money creates bigger bubbles. Tight money creates deeper recessions. Economists use leading indicators to try to predict where the economy is heading: the yield curve, unemployment rates, consumer confidence. But these indicators often give false signals or contradict each other. The global financial system. The US dollar is the world's reserve currency. Oil gets priced in dollars. International trade happens in dollars. Countries hold dollars as reserves. This gives America enormous power, but also enormous responsibility. When the US financial system sneezes, the world catches a cold. The 2008 crisis started with bad mortgages in America, but crashed economies from Iceland to Greece to China. Everything is connected. Countries sometimes engage in currency wars, deliberately weakening their currencies to make their exports cheaper. This creates global instability as everyone tries to gain competitive advantages through monetary manipulation. But this system is changing. Digital currencies, blockchain technology, and new payment systems are challenging the traditional banking system. Some countries are trying to create alternatives to dollar dominance. Most international payments go through the SWIFT system, controlled by Western countries. When they want to punish a country, they can cut it off from SWIFT, effectively isolating it from the global financial system. How the financial system affects individuals. Every decision made in boardrooms and government meetings affects your daily life. When the Fed raises interest rates, your mortgage gets more expensive. When banks tighten lending, it's harder to get a car loan. When markets crash, your retirement savings disappear. But you're not just a victim of the system. Your individual choices, how much you save, where you invest, what you buy, aggregate with millions of other people's choices to drive the entire economy. The financial system is neither good nor evil. It's a tool. Like any powerful tool, it can create enormous wealth or cause massive destruction. The difference is understanding how it works and using that knowledge to your advantage. So here's the reality. You now know more about how the financial system works than 90% of people. But knowledge without action is just entertainment. The question is, what are you going to do with this information? If this opened your eyes to how money really works, don't stop here. Start tracking your spending. Learn about investing. Understand your credit score. Build an emergency fund. These aren't just good ideas, they're survival skills in a world where the financial system affects everything. And if you want to keep learning about money, psychology, and how the world really works, make sure to subscribe and hit that notification bell. Because understanding the game is the first step to winning it.